Fund managers, individual investors and traders face the daunting task of deciding when to buy and when to sell a stock. One approach for timing the entry and exit points for a stock is through the use of technical analysis. Technical analysis is a method of evaluating securities by analyzing statistics generated by market activity, such as past prices and volume. In order to do this, technical analysts develop mathematical expressions, technical indicators, that identify specific relationships between historical prices and volume and the short-term stock price moves. Technical indicators are used mostly by active traders to time the entry and exit points for their traders. The use of technical analysis has grown to cover hundreds of patterns and indicators that can help investors make timely financial decisions. The technical analyst adopts trading strategies specifically developed for each of the indicators. Two of the most commonly used ones are the simple moving average, SMA, and the moving average convergence-divergence, MACD. These two indicators will be used in this paper to see how well they apply to frontier markets, and if they do, what parameters make them successful in generating true buy and sell signal, hit ratio. The hit ratio is the number of correct signals divided by the number of overall signals. Marshall and Cohen, 2005, considered prices of New Zealand stock market from 1970 till 2002 and evaluated the applicability of the SMA. They suggested the use of other complex technical indicators to predict future stock prices in New Zealand and stated that simple trading rules are no longer useful in that market. In contrast, RSI is an effective indicator that is widely used by both novice and experienced traders. Why is it so popular? Well, first of all, it is the indicator's simplicity of design. It is easy to understand once you learn how to use it. Another great thing about the Relative Strength Index is that it can be combined with multiple other indicators and support different trading approaches. Today we will look at a combination of RSI with another momentum indicator, MACD, and a simple moving average for a method that works both on short and long time frames. Relative Strength Index. The RSI indicator is used to measure the strength of the trend and find potential reversal points. It consists of a baseline of 14 period and two levels, overbought and oversold. These levels are set at 30 and 70 or 20 and 80, depending on the trader's approach. Setting the indicator at 20 and 80 is generally considered a more conservative approach. It makes the indicator less sensitive to price fluctuations and could potentially give stronger indications. However, it really depends on the trader's preference. MACD plus SMASO. How to use RSI and MACD together? This combination is a trio of a leading and two lagging indicators. RSI is a leading oscillator, which means that it shows the potential future changes in the price. Simple moving average is a lagging, trend-following indicator. RSI shows the possible reversal points and the SMA helps to confirm the signal. MACD shows the strength of the trend as well as its direction. In this approach, it is used to confirm the signals of the first two indicators. So, how to read MACD and RSI signals and use these indicators together. Let's look at the example below to see them in action. All trading involves high risk. Past performance is not necessarily indicative of future results. Hypothetical or simulated performance results have certain inherent limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not actually been executed, the results may have under or overcompensated for the impact, if any, of certain market factors, such as lack of liquidity. Simulated trading programs in general are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. For this strategy we will be examining the 4-hour chart of pound sterling to Canadian dollar. The indicators we will be using are a 100-period simple moving average, SMA, blue on the chart below, a 200-period SMA, red on the chart, a 15-period SMA, white on the chart, a 5-period exponential moving average, EMA, yellow on the chart, and the moving average convergence-divergence, MACD, with settings short-term, 12, long-term, 26, MACD SMA, 9. A trader should make a long entry once. First, the 5-period EMA crosses the 15-period SMA from below to the upside, while the current candle has already closed, and second, the two lines of the MACD also cross, while the current candle has already closed. The cross of the MACD lines can occur earlier than the cross of the 5-period EMA and the 15-period SMA, or right after it. However, no more than 5 candles must be present between the two crosses. The trader should abstain from making an entry if the two crosses are not present. The protective stop should be placed at the closest level of support, but the distance should not be less than 40 to 45 pips. This is used as a precaution in case a sudden huge move occurs. In other cases the stop will not be triggered, because the trader will have already closed his/her position. The SMA and MACD used in this paper are two of the most widely used technical indicators by market technicians to identify short, medium and long-term price trends. They are simple to calculate and their trading rules are easily developed and applied. Previous research shows